Welcome back, everyone. It's been a full week. I'm excited to be here. I was actually pumped to make a video. I had to take some time off of YouTube because, well, we had some events happen at the Carlson household. If you weren't aware, I posted it on my community channel. We have a new member of the Carlson clan, if you will. This is the baby, Sophie. I posted her on the internet. I know I'm biased, but I think she's pretty cute. So we had a busy weekend. This is more busy than usual, and I haven't been here for a week, but I was excited to get back in the market, thinking we're going to just have another fun video. We're going to jump into some stocks. We're going to do some due diligence. We're going to look at companies that are on sale. And then I'm greeted back into this market with this. Tech stocks are crushed in market sell-off. Completely crushed. And they're not using this term crushed lightly. We have companies here that they're listing off. Apple's down 5.87%. Microsoft is down 5.5%. Alphabet down 5.9%. These numbers aren't typos. They're not incorrect. All of big tech is selling down 5% plus. Amazon's down 7%. What happened to my Amazon today? Meta, for the people that think that low PE ratios protect you from a market sell-off, well, here's a lesson to be learned right here. We can take a look at Meta right now. It is down, that's right there, 9.37% today without an earnings report or really anything happening specific to Meta, and it's at a 14 forward PE ratio. This is the market today. Nvidia's down 9.47%. That's the worst one of the bunch. Overall, the market is just glaring red. I'm seeing these headlines here that are frightening. We have the NASDAQ down 5.16%, the worst sell-off in 6 months now. The S&P 500 down 4.32%. The Dow Jones wasn't spared. Even the dividend boomer stocks weren't spared. They're down 4% today. If I look at my portfolio, just a warning, this doesn't look good. If you have children in the room, you might want to shield their eyes because this is ugly. My portfolio is down 6.63% today. Just this portfolio. And then even my more conservative dividend portfolio is down a lot. Not 6.63%, but in total terms, it's down a lot. This is $7,000 gone overnight. I went to bed last night, and then I woke up having $7,000 less value in my portfolio. Just the story fund. If I look at my holdings, it looks like what you would expect. Every single thing is down across the board. I don't need to go through and name all of this. All of it's down like 5% plus. Crocs is down 10%. My biggest holding, Amazon's down 7%, and so on and so forth. This is indiscriminate selling based off some pretty big inflation news. Now, I don't need to remind you, I'm sure, of the inflation news. Just to summarize it, they expected, the overall expectations was that inflation would tick up slightly in August, that it would tick up a little bit, and it didn't tick up a little bit, it ticked up a lot. So in this video, I just want to jump in. I want to give my updated thoughts on inflation now that I have some time to look at it, because this was some surprising data, and I've made some projections and predictions on inflation in the past. I want to show you my thoughts on whether or not those are still going to be correct, or whether I'm incorrect in my prediction, my call that inflation would peak in March of 2022. So we have a lot to jump into. We're going to do a full portfolio update. We're going to look at the damage overall. We're also going to talk about inflation and give a quick update on that as well. So if you haven't already, subscribe to the channel. Let's go ahead and jump right in. Now, let's go ahead and get to, first of all, the headline news here. Inflation isn't just about fuel costs anymore, as price increases broaden across the economy. This is somewhat expected, and this is the basic concern. See, you have the headline inflation, which just includes everything, and then you have core inflation, which excludes food prices and oil prices. So we have these two different measurements of inflation, and the one that includes everything is more volatile, and it's the one that's kind of the driver of the core inflation, because oil prices going way up isn't something that you can look at in isolation. For example, if you think of oil prices going up and gas prices going up, you think of all those Amazon vans driving around, delivering your packages. Well, their cost of delivering the packages for Amazon goes up. So Amazon does something to adjust for that. They say we're paying a lot more for fuel. Fuel costs are going up. So we need to do a fuel fee for our sellers, a 5% increase, right? The sellers on Amazon, all their third-party sellers say, hey, you're charging us 5% more. Well, we're not going to just eat those costs and have our margins decline. If our margins are very low, we have to increase prices. So all of a sudden, just those fuel costs of all the vans driving around increase the prices on the sellers, and the sellers increase the prices on the things they're selling to offset that cost. And all of a sudden, when you shop on Amazon, your prices have increased. And the same thing can be said for literally every single industry. When you look at Walmart, they're shipping their things around in huge trucks and warehouses. If fuel prices go up, Walmart has to adjust to keep their margins. Those marginal adjustments feed into core inflation and things that don't even have to do with fuel. So what we have is the headline inflation, the higher number, bleeding now into core inflation. This is the process that it's followed. So if we look at this chart here, this is the one that I showed on my channel yesterday. This really illustrates the problem right now. You can see the core inflation hit its peak in March, and I thought that that is where the ultimate peak would be. I made a video saying that I think this is peak inflation. If you can't see it, it's at 6.5% in March. And up until this point, this actually was when inflation had peaked. Every subsequent month in April, May, June, July, inflation on a core level went down incrementally month after month, albeit by a little bit. It was trending downwards. So investors started to look at the trend and they were saying, you know what, I think this might actually be under control. I think the Fed may actually have a handle on this. They've been raising interest rates and core inflation has been going down. And better yet, fuel prices are actually going down. So things started to look good, but that delay of the headline inflation bleeding into core inflation finally caught up. It's now here. And it hit core inflation much bigger than expected. The expectations from most analysts, most people that I saw doing projections on this, were that core inflation was at 5.9% 2 months ago. And they were expecting August to come in around 6%, 6.1%, and then it came in at 6.3%. Way higher than it was all the way up until April, almost as high as it was all the way up until March. And March is the peak. In fact, if it went up 20 basis points more, just 0.2% more, it would be back to all-time highs. And now in September, it's looking even worse. It looks like core CPI will go up even more. There's projections from Goldman Sachs. You can see that red line right there. I'll zoom in on it so you can see it a little bit better. But this is Goldman Sachs projection. They're saying that in September, it's actually going to go up even further, basically getting to the point of peak inflation once again. Now, they think that that's going to happen until September, and then it will start to decline after that. But from now until September, these are two scary months. August and September are going to be two very troubling months in the market. And in my honest opinion, this is a lot worse than I thought it would be. I thought that core CPI would go up maybe from 5.9% to 6%, to 6.1%. I did not think it was going to go all the way back up to 6.3%, and neither did the market. That's where you're seeing this massive sell-off. This is simply put, just worse than general expectations. So what do we do in this situation? What do we do when inflation goes up further than expected? When we're feeling the pain of our portfolios going down? When you're looking at these numbers overall and across anything I'm investing in, there seems to be no solution. It's troubling to know what to do. I'm of the type of personality that when I see a problem, when I see something that seems to be broken, I have the natural urge to want to jump in and fix it. That's my natural tendency. If anything's broken, if there's a problem to be solved, I want to be the solution. I want to jump in and try to fix it. It's the same thing I've done at work as a programmer for 8+ years. I see code that's broken or something not functioning right. I want to jump in and code something new, fix whatever bug it is, and solve the problem. That's what I try to do. And that is the urge that I have in investing every time something seems to be going wrong. And with these big red numbers and stocks going down, it's a big signal to me that something's wrong and something needs to be solved. But everything I've read about investing, everything I've studied over the past couple of years on this subject, every book I've read from great investors, is that this is simply not a problem that needs solving. That markets go up and down. That inflation is very difficult to predict, and even more difficult to predict is interest rates. Trying to predict these things is usually not a worthwhile endeavor. Your investments should not be based around predictions. And in most cases, the huge majority of cases, the people that go in and try to mess with their investments, try to mix things up and sell out of certain holdings, and they do it based off of short-term information like this, in most cases, that actually causes more issues than simply doing nothing. Typically, in situations like this, if you've already done fundamental analysis, due diligence, if you've already done valuation work, if the thesis is the same for your companies, then there's not really any problem that needs to be solved. And it's very difficult, if you're like me, to ignore this and put it aside, but that's typically the best course of action. So what am I doing with my portfolio? Well, today I'm doing nothing. For the past month, I've done nothing with this portfolio. I've kept it precisely the same. The only thing that I'm really doing is making a deliberate choice, an action of deciding to do nothing. That's the big decision I'm making today, is really deciding to do nothing. So when I look at this again, this looks scary, and I'm sure that everybody looks at their portfolio. They see their numbers getting hit. Unless you have a huge inflation hedge or you have a very bearish like short position or something, your portfolio was probably hit today as well. What I like to do is just zoom out a little bit. If I zoom out 1 week, just 5 days, this portfolio is basically flat. That's the big scary news today. It hasn't changed in 5 days. That's the big news. The portfolio went up around 7%. It went down around 7%. That's where we're at the past week. So look, in a way, I am making an active choice. I'm deciding to do nothing, which given the situation is a difficult choice to make. Sometimes the easier thing to do is to go in and mess with your portfolio, but I'm not going to be doing that. I'll be waiting patiently for things to pan out with this economy. I think it does require a lot of patience. In terms of macro predictions, I do want to clarify one thing. I made a call that inflation would peak around March of 2022. So far, that still holds, but that could change in September. Right now, I consider it a coin flip. I think that in September, it might be above 6.5%, in which case my call of it peaking in March would be incorrect. So we'll have to wait and see. But I just want to clarify one thing. When I make calls about macroeconomics, macro trends, inflation, these type of things, they're purely from a speculative standpoint. I am not putting any money on this call. I know some people do this, but I don't base my investments off of macroeconomics. My investment in Amazon is not based on Jay Powell and how much he will or won't raise interest rates. It's not based on inflation. It's not based on where the CPI report will be next year. That's not why I'm investing in Amazon. If you want to see why I'm investing in this company or Google or Netflix, I have many videos on the subject. I have a 3-part series, 1 hour each, specifically on Amazon, and all of it has to do with fundamental research on this company, on AWS, this powerhouse of a earnings machine, on the future free cash flow of the company, on their third-party seller, the growth of the company, on their media properties, on their advertising business. It doesn't have anything to do with inflation or CPI reports. So I just wanted to make that distinction. I'm not basing any of my investment decisions on this chart or where I think it will be. I am basing it on fundamental research. I do realize that this stuff, though, this inflation data does have a huge impact on equity prices, at least in the short term. If inflation does run out of control and it continues to go up, and I'm wrong in my call that it was peaked at March, if it continues to go up to 6.5% and 7%, and by the end of the year it's not lower, that's going to be bad news, not just for my portfolio, but for the entire equity markets. So I hope inflation goes down, not only for my portfolio, but for the entire stock market and the economy. I don't think it's good to have high inflation for long periods of time, economically speaking. So I hope inflation goes down. If it doesn't, we'll be in a different ballgame. Investing is going to become even more difficult. In the meantime, I am going to stick to fundamental research. So going forward, we're going to have a lot more videos diving into these great companies. I'm going to be doing deep dives into them, looking at the profitability, the fundamentals of the company, because anytime you're getting bogged down by macroeconomics and looking at all the doom and gloom, I like to dive into the numbers and see what my companies are actually doing. Sometimes it's painting a completely different picture. So we'll be doing more of that in the future. I'm glad that you joined in. I'm glad to be back. I'll have more content out soon, and I'll see you in the next one.